Hello and welcome to this Taxes in 10 video, where we take a tax topic and break it down in about 10 minutes. My name is Mark Barnes, and I'm the managing partner of Copper Canyon Tax and Accounting Services in Tucson, Arizona. We are a boutique firm that specializes in small business accounting and taxes. This episode is on the basics of basis and distributions. The concept of basis is fairly simple: a person's investment in a company. But the calculation is not so simple. This course will not go too deep and should be considered a starter course. Let's start by looking at a more traditional basis concept. You bought shares of stock in a publicly traded company, a company like Target or Home Depot or Apple. If you invest $10,000, your basis in the stock is $10,000. And generally, it doesn't change unless there is a stock split or a non-dividend distribution called a return of capital. When you sell the stock, you will recognize a capital gain or loss depending on your sales price. Your gain or loss would be considered short-term if held for 1 year or less, and your gain would be considered long-term if held for more than 1 year. Let's say after 5 years, you sell your stock for $15,000. You will recognize a long-term capital gain of $5,000. This is reported on Form 8949 and will flow to Schedule D. S corporation and partnership basis starts off the same. How much did you initially invest in your stock shares or partnership interest? For corporations, the attorney we use typically authorizes 1 million shares at a par value of $1 each. Then the owner will determine how much they will invest in the company, and that number of shares will be issued. A $10,000 investment would result in 10,000 shares being issued and purchased by the shareholder. The initial basis in the S corporation would be $10,000. The big difference here is S corporation basis is ever changing. When computing stock basis, the shareholder starts with their initial capital contribution to the S corporation or the initial cost of the stock they purchased from a third party. That amount is then increased and or decreased based on the pass-through amounts from the S corporation. An income item will increase stock basis, while a loss, deduction, or distribution will decrease stock basis. Looking at a K1, basis is increased by ordinary income in box 1, separately stated items in boxes 2 through 10, tax-exempt income in boxes 16A and 16B, and excess depletion in box 15C. Basis is decreased, but not below zero, by ordinary loss in box 1, separately stated loss items in boxes 2 through 12O, 14P, and 14Q, non-deductible expenses in box 16C, and non-dividend distributions in box 16D, and depletion for oil and gas in box 17R. Think of it like this: how much did you put in, leave in, and loan in? Let's take a look at an example. Jack starts an S corporation. His initial investment is $1,000. At the end of his first year in business, his books show a profit of $25,000. Included in this number is $1,000 of non-deductible meals, $1,500 in charitable contributions, and $25 of interest income from a savings account. Let's start with calculating his taxable income. $25,000 per books plus $1,000 in non-deductible meals plus $1,500 in charitable contributions minus $25 in interest income equals $27,475. This is the number you will reconcile to on your Schedule M1, reconciliation of income or loss per books with income or loss per return. I covered that process in our Taxes in 10 video, Books to Tax and Schedule M1. All three of these items will be separately listed on Jack's K1, and all three will affect his basis. Charitable contributions will flow to Schedule A, and interest income will flow to Schedule B. You subtract out the interest income because it will flow to his personal return and retain its character as interest income and be subject to tax there. Same happens with charitable contributions. They aren't deductible at the business level, but instead flow through and are treated as a deduction on his personal return. If Jack doesn't itemize, the deduction is lost. Let's look at his basis. Capital contribution of $1,000. Addition of ordinary income, $27,475. Addition of interest income, $25. Subtraction of non-deductible meals, $1,000. And subtraction of charitable contributions, $1,500. A little math, and we have basis before distributions of $26,000. Jack will pay tax on ordinary income of $27,475 and $25 of interest income, and he may be able to deduct $1,500 in charitable contributions. Here's a look at Jack's basis statement. Line 2 shows his stock purchase. Line 3A shows his ordinary income. Line 3D shows his interest income. Stock basis before deductions is $28,500. Here's the second half of his basis statement. Line 7A shows the non-deductible meals. Line 9H shows the charitable contributions. Line 11 shows his year-end stock basis of $26,000. Jack may or may not make a distribution of up to $26,000. Any amount not distributed will be rolled into retained earnings. Retained earnings is money previously taxed but not yet distributed. This amount can be distributed at any time in the present year or a future year. In year number 2, Jack has a challenging year and gets a bank loan for $50,000. At year end, Jack has a net loss per books of $36,000. Included in that are $1,500 in non-deductible meals and $500 in charitable contributions. During the year, he took distributions of $30,000. Back to basis. Beginning basis, $26,000. Subtraction for ordinary loss, $34,000. Subtraction for non-deductible meals, $1,500. Subtraction for charitable contributions, $500. A little math, and we have a basis before distributions of $8,000 negative. Wrong. Basis cannot be negative, and it's about to get worse for Jack. There are ordering rules. A shareholder must decrease basis for the following items. 1. Distributions other than those taxed as dividends under Section 1368. 2. Separately stated items of loss and deduction and any non-separately computed loss. And finally, non-deductible expenses that are not properly chargeable to a capital account. Jack has an issue. His basis was $26,000, and there are no additions. His distributions of $30,000 reduce his basis to zero, and he has $4,000 of distributions in excess of basis, which will appear as a long-term capital gain of $4,000 on Form 8949. Next, we address his separately stated items. They're suspended into the future. Now we address his loss. It is also suspended into the future. Year 3, Jack's basis is zero. He has income per books of $55,000, which includes $500 of non-deductible meals. His beginning basis is zero. Addition for ordinary income, $55,500. Next, we'll subtract the suspended non-deductible previous year expenses of $1,500. Then we will subtract the $500 non-deductible meals from the current year. Next, we will subtract the suspended losses of $34,000. Finally, we will subtract the suspended charitable contributions of $500. Little math, and we have a basis of $19,000. Had Jack taken distributions in year 3, we would have to reduce his basis prior to considering his suspended items. Remember that cash in the bank and basis don't go hand in hand. As soon as you add liabilities to the balance sheet, your cash will go up, and that can cause distributions in excess of basis. Doesn't matter if it's unpaid payroll taxes, sales tax, credit card debt, or a bank loan. Doesn't debt increase your basis? An S corporation is different than a partnership. A partner can see an increase in debt basis for recourse debt. In an S corporation, you only see an increase in debt basis if you make a personal loan to the corporation. The loan should be treated like a loan. It should be documented, carry a reasonable interest rate, and have repayment terms. That's what makes a loan. Borrowing money from a bank does not increase basis, even if you guarantee it. In our scenario, if Jack had loaned the company money rather than taking a bank loan, he would have seen an increase in his debt basis. This would have allowed for him to deduct those losses rather than suspending them. Losses of the S corporation are passed through to the shareholders. Losses are deductible, assuming the shareholder has basis in their stock, and once all stock basis is exhausted, to the extent the shareholder has basis in debt to the corporation. It is important to note that stock basis is used first, and then losses may pass through to the extent that the shareholder has made a loan directly to the corporation. If you have a shareholder with debt basis, it is very important to track the activity. I know it's the shareholder's responsibility to track basis, but how many of them can really track it? You have to record the original debt, the principal payments made to the shareholder, and you have to consider the basis in their debt in relation to losses allowed. The repayment of debt is typically tax-free recovery of capital, but it can result in gain if the basis is less than the amount owed. An example, Jack has a $50,000 note payable with a basis of $25,000 because he deducted losses against it in a prior year. Then the S corporation repays $25,000 in principal. Jack will have a capital gain of $12,500 on the repayment. This is because, under Revenue Ruling 64-162, the shareholder cannot designate the entire payment as basis recovery. Rather, the recovery of capital is allocated proportionate to the basis and face value of the note. $25,000 repayment times $25,000 basis divided by $50,000 owed equals $12,500 of capital gain. In the scenario where Jack had a loss, the math is tricky. He would still have a capital gain on distribution in excess of basis of $4,000. Then he could have applied $36,000 of his debt basis towards his loss and non-deductible items. This would allow him to deduct the losses against his other income and leave him with $0 in stock basis and $14,000 of debt basis. Year 3 is complicated. He needs to restore his debt basis before any repayment is made, which goes against the philosophy that he needs to have a traditional loan amortization schedule. Otherwise, part of it will be taxable. He needs to have an overall basis increase of $36,000 in order to fully restore his debt basis. Then in year 4, repayment could begin without recognizing a capital gain. Make sure to hit the subscribe button to keep up to date on all of our Taxes in 10 video series, and give us a like on Facebook at facebook.com/potentialcpe. If you are interested in earning continuing education on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4-hour on-demand webinars will focus approximately 75% of each hour educating theory and regulation, and 25% of each hour on procedures with real-life examples, and walk you through completing the necessary forms to increase your potential.